Thank you. Appreciate that. And thank you all for showing up here on a gorgeous day in Denver. So it's nicer to be outside than inside, so I appreciate you guys being here. Forward-looking statements and disclaimer. This is on our website as well, and non-GAAP measures, etc. So let me flip through that. So our company is financially stable. We've got a sound balance sheet, low debt, have strong corporate governance, and we're rapidly growing. We have high-quality assets in Oklahoma, and we'll go into that. And one of the things that makes us stand out is the ratio of our PDP to PUDs. And I think as people realize how low risk our PDPs are of converting those to PUDs, or our PUDs to PDP, I should say, sorry, that will get our valuation up near our peers, because I think we're drastically undervalued on a reserve basis, value basis going forward here. Let's see. So our field history, where we are, as I mentioned, in Oklahoma. We're right outside of Ardmore, so halfway between Dallas and Oklahoma City. And you can see other operators around us. We're the very southern part, southeastern of the Scoop play, basically. We originally drilled the Woodford Shale. So we had drilled and participated in about 40 wells, had about 12,500 acres at the time, and we were very gas-rich. We were 15% oil, basically, and the rest was gas and natural gas liquids. We sold that to Exxon for $147 million. If you look and see the pink down there in the lower right-hand side, that's all Exxon all around us. So they had basically bought out everyone else in the area. We were the holdout, and we said, hey, look, we just started looking at this little shallower interval. It was about 350 feet shallower than the Woodford, called the KEI. We want to hold on to that, or if you want to pay us for it, that's great, but they didn't want to pay us what we felt it was worth. So they really wanted the Woodford anyway. So we ended up selling that, but we retained the rights to the Upper Sycamore and the KEI, and we're glad we did. We grew the acreage position to over 17,000 acres. Our production now is 75% oil. So we've really been transformed from a natural gas producer to a liquids-rich, mainly oil producer. And we've grown the acreage, as I mentioned, about 17,000 acres, and the reserves, 33 million proved, and about 54 million on a 2P value. Management team, myself, 36 plus years in oil and gas, everything from land to a lot of operations experience to finance. I've done a little bit of everything and a lot of other things. Gary Johnson, over 30 years of accounting experience, 20 years in the oil and gas side of things, where he was also as Oxy Director of Technical Accounting. And Gary's here with us as well, sitting in the audience. Greg Presley, our VP of Engineering, and Alan Hemme, our Senior Geologist, have been instrumental in our development of the field and the optimization of the field, because we've really changed some things over the last couple of years. Board of Directors. What I like to say is we have all the bases kind of covered with them. We've got David Newhouser of Livermore, got lots of capital markets experience. He's out of Chicago, owns about 14% of the company. We've got Eric Brown, our CPA equivalent in Canada is called a CA, and we are Canadian listed primarily. We do have a US listing as well on the OTCQX. Eric's head of our audit committee. We've got Leslie O'Connor, who's a Denver resident here. She's reservoir engineering side of things. She used to run MHA and as well as Spruill's Denver office here in Denver. So she's been a great addition as well. And then Evan Templeton has lots of experience on the high yield and leverage credit trading side of things. He was the managing director of leverage credit trading for Jefferies before his recent position at West Oaks Advisors. Company information, as I mentioned, we're traded on the TSX, Toronto Stock Exchange proper, under the ticker KEI. We also have a OTCQX listing as KGEIF, and we are looking into whether or not we get a full listing on the US or not. So that's in process of being evaluated here. So shares outstanding, 35.6 million roughly. US market cap is a little down from this. This says 165, we're probably in the 145-ish today. On US dollars, all our reporting is in US dollars, by the way. Our net debt, shallow, just under 17 million at the end of second quarter here. And our debt to EBITDA, 0.6. So we try to keep our debt down and compare that to our asset value. That's why I said we're cheap, basic on a value basis. proved reserves of 515 million. Netherland, Sewell does all our reserve engineering. And, excuse me. So you can see that we're quite undervalued on a proved basis. Even our proved and probable is 700 million US. Our 2023 forecast, 3,600 to 4,000 BOE a day. Exit rate, we're figuring between 4,500 and 5,000. Our adjusted EBITDA, we're projecting 52 to 55 million for the year. That's at a $75 oil price, so we're a little less than that in the first half of the year. As far as oil price goes, second half, hopefully it'll be a little better considering we're floating around 80 now. And our CapEx is 44 to 51 million, so you can see we're trying to stay within our cash flow to grow. And you can see what we're doing here. In 2021, where we hadn't drilled a well in 3 years, our cash flow was adjusted EBITDA was 6.5 million. In 2022, when we started drilling wells, we quadrupled our adjusted EBITDA to 25 million. And this year, we're projecting to double that again to 53 million. So you can see we're on an upward trajectory of growth. Production, you can see where we were just producing the wells that we had drilled in the past when we hadn't drilled for 3 years. And then you can see what happened when we started drilling. Our production is increasing. And our second quarter exit rate, because we had 3 wells come on just right at the end of the quarter, was about 3,400 BOE a day. And our net operating income, the red line represents what our average BOE price per barrel was for each quarter. As you can see, even when oil prices and the BOE price was down, we've still been growing our net operating income. And so we expect that trajectory to increase and continue. 2022, I mentioned we hadn't drilled a well in 3 years. We basically employed a new completion technique. And at the bottom of the green line, sorry, there's no pointer here, but you can see the 2021 PUD curve that Netherland, Sewell had put together. That was going into 2022, obviously, and we drastically exceeded what we were expecting to produce from these wells. We have a new completion technique that we used where instead of going linear and cross-linked gels to going more of a slick water, high-vis friction reducers, and that has made all the difference in the world. Also using diverters, but basically we're stimulating more rock volume closer into the wellbore, making better and better wells. So the 2022 wells are performing really well. You can see the variability in it, and I wish I had more wells like the Glen 16, the purple line you can see there. I'm assuming that's going to start dropping off at some point, but nice to see when a well suddenly almost flatlines for a little while. And no earlier comment by someone that I met with today, we did not tap into a pipeline for that one. Here, 23 drilling program. I mentioned we just drilled 3 wells that were on production. So this was our first downspacing in the field. We downspaced 2 of the KEI wells on one pad, the Barnes 8-1 and 8-2. And then we had placed one in the upper KEI and one in the lower KEI. We wanted to kind of do a wine rack. We were thinking that might be the most efficient way of completing these downspacings. And we also drilled a T-zone well, which is right below. It's still KEI, but we found a frac barrier in between the KEI and the lower part of the KEI, so we broke that up into what we call the T-zone. And I'll go into that in a little bit more detail on these next slides where that makes more sense. Our well expectation for the year was to average about 75% of what we did in 2022. Our wells came in under budget. For those 3 wells, we did about $6.5 million for each well, including all facilities hooked up completely. We had budgeted $7.2 million at the time. And then going forward here, we have the 3 wells that I mentioned that we drilled already. We have a 2-pad well that we're drilling right now for just KEI because we hadn't known the results from our T-zone well. We didn't want to commit to drilling another one of those till we actually saw the results. And then now we've also committed to drilling a 3-pad well with 2 KEI and another T-zone well. And those will all be drilled back to back from 2 different pads. So testing the T-zone, as I called it. You can see on the right-hand side of your screen, we've got the KEI itself and then the T-zone right below it. A couple of our early wells, we had drilled into the T-zone and found we didn't think we were fracking up into the KEI. And so they had a little higher declines, but they were really drastically understimulated. I mean, 50 to 75%. We're putting about 2,000 pounds per foot of proppant in now, and back then the highest we had in there was 1,000 pounds per foot. So we had a good initial rate, but they declined harder. But we felt like with our new fracture stimulation technique, it was better in the KEI, should be better in the T-zone. So hopefully we can make economic wells in the T-zone. And if we can make economic wells in the T-zone, we can add a lot more reserves and a lot more well locations to what we have currently. And so all of the Netherland Sewell reserves right now are just literally in the KEI, giving credit for that at 6 wells per section, by the way. So the early results of the T-zone that we announced a little over a month ago, initial rates look very encouraging. Declines are less, so we're hoping that stays in there and we can add a lot more reserves. And obviously we feel confident enough for that to drill another T-zone well as well, along with the KEI wells as we're going. So last year at the end of the year, Netherland Sewell reserve report, 60 proved locations, 63 probables. These are all from them, their locations. You can see the green in the middle there that I can't point to again is where our approved locations are, and that's what we consider the core of our field as well. We do expect to expand that out a little bit further as we go on, but for now we're just developing the middle of it. So as I mentioned, 17,000 net acres right now. Most of these wells that we drill we have 98 to 100% working interest. Infrastructure is all in place here from the deeper KEI, or deeper Woodford, excuse me. So even on the east side, where you can see in the light yellow outline in the boxes, it's all held by production, by those Woodford wells that we originally drilled, and then Exxon has drilled more wells in here as well. And so that's why we were able to take a hiatus for 3 years from drilling, where we had just paid down debt and not drilled any wells because we didn't have any lease expirations. So we were able to go forward with that. The area that Netherland Sewell evaluated, about 82% of our acreage, and as I mentioned, 99% is held by production. So just zooming in a little bit, the Barnes 8-1, 2, and 3, which were the 2 KEI wells, and the T-zone well that we brought on, is located in the west half of section 8, and we're drilling right now in the west half of section 7, and then the next 3 wells will be located in the southeast of section 17, so that would be to the southeast of those Barnes 8-1, 2, and 3 wells. This slide is in here just to show why we think the reservoir is so good and what I think Netherland Sewell thinks it's good as well. If you look at our EUR's estimates from Netherland Sewell over the years, you can see every year they've increased what those are. And so in 2022, we're up to 572,000 BOEs that they expect that we're going to recover. You got the PUD infill location of 485. The reason that there's a difference is when we're in sections that we've drilled really good wells that they're projecting are going to produce way more than the 572, they've discounted what's remaining in that section. We think that these wells are still going to outperform. They'll hopefully have to revise that up, but they are conservative, and I understand where they're coming from. So, as I mentioned before, 75% of what the average production was last year is what we figured these wells would do. So we want to stay kind of in that green band, which is 75% of our best well and 75% of our poorest performing well, which is still above the 2021 forecast that we had originally had. The Barnes 8-2 was our lower KEI well that came in the band, and the Barnes 8-1H, which was the upper KEI, came in a little lower than expected outside of the band, but that also, with the science and the data that we've gathered, did a bunch of tracer surveys and things like that, we realized that we should probably drill lower KEI wells that we are stimulating all the way up into the upper KEI, and the upper KEI didn't really stimulate the full section down below. So that's why the future wells are all going to be lower KEI wells as we go forward here. And the T-zone came in, like I mentioned, quite well and is performing quite well. So we're hoping that that continues to do so. Enterprise value versus NAV. So this was at a 6.25 Canadian stock price. We're down about $1 from that, not quite, 75 cents or so. So this is quite conservative at this point, but still even that, it shows that the average, these are peers in Canada because we do our Canadian reserve report, so we try to compare ourselves to that. We're trading about a half of what our Canadian peers are trading for on a value basis. Going on this 2P number is the same thing, we're about half. And so we said, okay, why are we down here? When we look at what the value is, it's all about making money, right? So our operating netbacks in the US are $44 a BOE. This is for all first quarter numbers from all these companies. So we're drastically higher than our peers. When we look at our G&A on a BOE basis, that's all coming down nicely. On an OPEX per BOE basis, we're down at $6 a BOE of OPEX. which is on the lowest end of all of our peers as well. And the two that are closest to us are mainly natural gas producers. One of the nice things about our field is we don't produce a lot of water. When the field was making about 1,000 BOE a day, we only had about 100 barrels a day of water. So all of our water gets trucked out of the area. We don't have to build big infrastructure or anything else like that. It really helps on OpEx, and we have quite an efficient operation going forward. So my argument is we shouldn't just be trading at where our peers are, but by the average are. We should probably be doing better than that because we're doing better on a netback basis. So this is a theoretical, and this does confuse people. Sometimes they're like, oh, your plan is to keep production at 4,000 BOE a day. No, it's not. But it's more along the lines of we get the questions of like, oh, you're a shale producer, so you have high declines. So people start asking the questions of, well, how many wells do you have to drill every year in order to hold it there? And really, when we look at this, we had said, look, we drilled 6 wells in 2023, which we're doing a little bit more than that. We need 2 wells in 2024, 3 wells in 2025, and 3 wells in 2026 in order just to hold it at this theoretical 4,000 BOE a day level. Realistically, we're going to drill more wells than this, right? We're going to recycle some of the money. We're going to have production higher than this. But it goes to show you just even holding it at that 4,000 BOE a day, if you look on the lower right-hand side, our adjusted EBITDA after CapEx, assuming a $7.2 million well, not the 6.5 that we just knocked out, and using our assumed decline curve at a $75 oil price, we're generating a lot of cash flow. And so you look at this and say, okay, if it's 3 wells a year, we had 60 proved locations, that's a lot of running room, right? So there's a lot of room for us to grow production even further, move up, but it doesn't take that many wells in order just to hold production nicely. You're not just putting a bunch of money in the ground in order just to hold production where it is. So again, I'm sure it'll be more than this that we do, but we haven't put out long-term guidance, so this is a theoretical assumption for this. So why us? Great asset. We've got good corporate governance in place, got years of drilling, good drilling inventory. We've got a reserve report that has great reserves in it, hoping to add by adding the T-zone in as well. And we're going to look at continuing to just drill our low-risk wells, prove everything up, try to shrink that differential that we have between us and our peers just by doing our business the right way. And that's what it's all about. Don't take on a lot of debt. Don't take on a lot of risk. We've been in the oil and gas business a long time. The methodical process of doing this has shown that we can get good results, growing cash flow rapidly, increasing the company size, and that's what our goal is, to keep going and keep doing the same thing. So with that, that's it. So stock's on sale. Load up.